Hello, everybody. I hope everybody's doing fine. I'm in Module 7, which deals with GILTI, FEDII, and BEAT. And what I'm going to do in this lecture is FEDII, which is an acronym for Foreign Derived Intangible Income. It's covered by Section 250 of the Internal Revenue Code, and like the other provisions, as well as 965 and Section 245 Cap A, it was enacted as part of the Tax Cuts and Jobs Act in December of 2017. Let's again go through the Steptoe and Johnson slides with respect to foreign derived intangible income. And so again, these were produced in January of 2018. They reflect the statute, but do not reflect the regulations and any other IRS guidance with respect to the provision. So let's go. I think I'm going to page, I was on 45, going to 46, I think. So foreign derived intangible income, or the acronym FDII, FDII, rules are designed to provide incentives for ownership of intangibles and activities in the US. So unlike provisions like GILTI and BEAT, this is a taxpayer favorable provision. These are producing additional deductions for taxpayers. The second bullet says, for taxable years beginning after December 31st, 2017, and before January 1st, 2026, a U.S. corporation is allowed a deduction in any amount equal to the sum of 37.5% of its FDII plus 50% of the GILTI of any that is included in the income of the taxpayer. We learned about GILTI in the GILTI deduction in the last webcast, or last lecture. In the third bullet, the Steptoe and Johnson author writes, for taxable years beginning after December 31st, 2025, the deduction for FDII is reduced to 21.875%, and deduction for GILTI is lowered to 37.5%. Again, under the House Build Back Better Act, which was not enacted in 2021, the FDII benefit would be reduced immediately, or when the legislation became effective, but that has not been enacted as of yet, as of this January 3rd, 2022, when I'm recording this lecture. Let's go to the next slide. And this is a very important equation, and I think I'm going to keep it up in front of you as I go through the material. So FDII equals deemed intangible income times a fraction. The numerator is foreign derived deduction eligible income. The denominator is deduction eligible income. The deemed intangible income, the first part of the equation, in turn is equal to deduction eligible income less 10% times QBI, the qualified business asset investments. Deduction eligible income equals gross income, less exclusions, less deductions, including taxes. And we'll come back to it, but the exclusions are subpart F, GILTI, financial services income, dividends from CFC, domestic oil and gas extraction income, and foreign branch income. Foreign derived, which is very, very important, encompasses property sold to a foreign person for foreign use, or services provided to any person, or with respect to property not co-located in the United States. Foreign derived also encompasses the license of foreign intangibles. That's a very important to many taxpayers. That can be a very important FDII benefit. Let's go on. When I go to the lecture, I'm going to come back to this slide though. Sorry. So the fraction is still there. Let's read the first bullet, or the equation rather. Deemed intangible income is equal to the excess of deduction eligible income over a fixed return, 10%, unqualified business asset investment, or QBI. Deduction eligible income is gross income minus exclusions and minus attributable deductions, including taxes. The exclusions are 1, subpart F income, 2, GILTI, 3, financial services income, 4, dividends from CFC, 5, domestic oil and gas extraction income, and 6, foreign branch income. And the last bullet says qualified business asset investment, or QBI, is defined in the same manner as it is for GILTI computation. We discussed that earlier. QBI is determined as the average of the adjusted U.S. tax base determined at the end of each quarter of a tax year in specified tangible property that is used in a trade or business and is subject to a U.S. tax depreciation using depreciation rules similar to those used for GILTI. So, straight line rather than accelerated. And there's that equation again. Foreign derived, for purpose of determining foreign derived deduction eligible income, is income resulting from sales of property sold to a foreign person for foreign use, or to services provided to any person, or with respect to property not located in the U.S. Not listed there, but certainly an important part of the FEDII benefit is licensing of foreign intangibles. The last bullet says, note that property rule turns on foreign person and foreign use, whereas the services rule turns on the location of the person for whom or the property with respect to which the services are performed, whether U.S. or foreign. To qualify as foreign derived, sales of property must be treated as made to a foreign person. There is no explicit intermediary rule that allows a sale to a U.S. person to qualify that U.S. person later sells to a foreign person. In the above, the sale from USP1, you can see that, to related USP2, and the sale from USP1 to unrelated USP3 would not qualify unless the sales were recharacterized. The sales from related USP2 and the unrelated USP3 to unrelated FP1, foreign person 1, may qualify. There's special rules that apply to determine whether if property is sold to a foreign person, the property will be treated as sold for foreign use. If USP sells property to a foreign person and that foreign person further modifies the property within the U.S. before using such property for foreign use, the sale by USP does not qualify as foreign derived. Let me see if you can see the whole slide. If a taxpayer provides services to another person located within the United States, the income from such services does not qualify even if such other person uses such services in providing services to a person not located in the United States. Note that services provided to a branch of a foreign corporation located in the United States would also not qualify, even if the branch uses such services to provide services to a person located outside the U.S. If property is sold to a foreign related person, such sale is not treated as for foreign use unless the related foreign person ultimately resells the property or uses the property in connection with property that is ultimately sold to another unrelated foreign person for foreign use. If a taxpayer provides services to a related person who is not located in the United States, the income from such services is not foreign derived unless the taxpayer establishes the service is not substantially similar to services provided by a related person to persons located in the United States. Again, if I test you in this area, it's just going to be an overview of FEDII, but you're trying to learn this stuff to help your clients, obviously. And let me stop sharing this. I will put this back up. I want to share one more PowerPoint that may be helpful, or slide chart rather, that may be helpful. So let me find it. This is produced by your firm, I guess the US office of your firm. And this is how they chart out the FEDII deduction computation. So you take deduction eligible income. I'm starting on the top left, deduction eligible income. I'm going horizontal, less 10% times qualified business asset investment QBI of a U.S. corporation equals deemed intangible income, or DII. Deemed intangible income times the fraction. The numerator is foreign derived deduction eligible income, sometimes referred to as FDDEI, over deduction eligible income equals foreign derived intangible income. Foreign derived intangible income in turn times the applicable percentage, currently at 37.5%, will give you the FEDII deduction. So I'm going to stop sharing. I did ask that this be put on the class's website, along with the Steptoe and Johnson. Let me stop sharing. I do want, however, to go back to Steptoe and Johnson. So let's do that now, share. And I just want you to have the equation in front of you as we go through this. Okay, I just want you to see this. He had it in many, they have it in many slides, but this FEDII equals deemed intangible income times foreign derived deduction eligible income over deduction eligible income. Let's go through some of the material in your text. Professor Loken covers FEDII in paragraph 66.99. I'm sorry. As you see in the screen, we talked about FEDII equals deemed intangible income times the fraction, where the numerator is foreign derived deduction eligible income and the denominator is deduction eligible income. Deemed intangible income, as we talked about, is in turn defined, and it's done so in section 250, little b in parenthetical, 2 in parenthetical, as deduction eligible income less 10% times qualified business asset investment, or QBI. Again, beside reading 66.9, I'd urge you to read code section 250 in its entirety. I'm not going to go through the code as part of this lecture, but it's something that you should go through. And again, by all means, email me with any questions. But the benefit, the FEDII benefit, is only available to domestic C corporations. It does not apply to S corporations. It also doesn't apply to RICs, which you may have learned stands for regulated investment companies or mutual funds, nor does it apply to REITs, REITs, which are real estate investment trusts. So, RICs, REITs, and S corporations do not get the FEDII benefit. Individuals don't get the FEDII benefit, only domestic C corporations. It can apply to corporate partners of a partnership, however. There's a good article, by the way. Not sure if you have access to it, but Jack Cummings, who written numerous articles, but he wrote about really every major international tax change made by the Tax Cuts and Jobs Act, has a good article with respect to FEDII. It's in the May 7th, 2018 tax notes. The article is titled Foreign Derived Intangible Income Deduction. So let me go on. Let's go. Cummings notes that FEDII is designed to encourage exports but it's not limited to exports of goods, but also includes providing foreign services and licensing foreign intangibles. So all three of these can give rise to a FDII benefit. Jack Cummings in his article observed that computing the multiplicand that is deemed intangible income for the 37.5% deduction is the heart of the regime. And it starts with deduction eligible income, referred to, or the acronym is DEI, which is all domestic corporations' gross income minus specific categories netted by allocable expenses. The taxpayer will use deduction eligible income in two ways. So we've seen one, to tease out the foreign derived deduction eligible income known as FDDEI, which is a numerator of the fraction. You can see it up there, foreign derived deduction eligible income over deduction eligible income. And also deduction eligible income is important because one needs to deduct from deduction eligible income a 10% return on qualified business investment assets, or QBI, to identify the deemed intangible income at the beginning of the fraction. Remember, it's FDII equals deemed intangible income times the fraction of foreign derived deduction eligible income over deduction eligible income. So focus on that equation. So let's go through some of the material in your book in paragraph 66.9. Let me take a quick drink. Professor Loken notes in the first paragraph of section 66.9 that a domestic corporation is allowed deduction equal to 37.5% of its foreign derived intangible income, or FDII, the taxable year. That's section 250, little a in parenthetical, 1 in parenthetical. Let's skip the rest of the sentence, which addresses GILTI. Remember, the GILTI deduction is also located in section 250. So like GILTI, the deduction is limited to domestic corporations, as we noted. Loken goes on to write, and not S corporations, not REITs, and not RICs, let me add. Professor Loken goes on to write the second sentence of the first paragraph on page 66 paragraph 66.9, that the amount of FDII and GILTI taken into account in computing the deductions are ever proportionally reduced for any taxable year if the sum of the amounts otherwise taken into account exceeds the domestic corporation's taxable income. This too would have changed under at least the House version of the Build Back Better Act, if in fact it's enacted into law. But so far it hasn't, at least as of January 3rd, 2022. Loken notes in the third sentence of the first paragraph in 66.9 that the deduction is allowed for all taxable years beginning after 2017, but it is reduced for years after 2025 from 37.5% to 21.875% for FDII, and for 50% to 37.5% for GILTI after 2025. Again, this would have been expedited if the Build Back Better Act had been enacted. Skipping some material, let's turn to the computation of the FDII deduction, which is dealt with in the second paragraph of 66.9. Loken writes that the meaning of the term global intangible low taxed income is discussed elsewhere. The calculation of domestic corporations' FDII is based on a complex set of defined benefits, One, a corporation's deduction eligible income is the portion of its taxable income. The portion includes all of the corporation's gross income except the following amounts. And rather than read that, you'll see that in the slide in front of you. The second, let's see if you can see this clearly. Hold on one second. the second bullet, sets forth the exclusions, so I won't repeat those. And then finally, and this is dealt with in also in the second bullet, the deductions taken into account are those deductions, including taxes, that are properly allocable to the included gross income. These could include, for example, state taxes. Let me go on. Jack Cummings, in his article, observed that deduction eligible income is built up from all gross income minus the exclusions, net of deductions allocable to the remaining gross income. And he goes on to say, and yet the exclusions will be a minor part of many taxpayers' incomes, meaning that most of their entire Form 1120, which you guys know is the corporate tax return, could remain intact for finding deduction eligible income. Cummings notes that the largest deduction in computing domestic eligible income is likely to be interest. He also pointed out that bonus depreciation, which you may have covered in your tax accounting course, or section 168 little k, will create, or expensing, will create a new category of one-time deductions. Taxes such as state and local taxes also serve to reduce domestic eligible income. Cummings notes that the most important point about deductions is that domestic eligible income, and in turn FEDII, is based on profit as specially computed and not on sales. Let's go back to Loken on 66.9.2. Loken writes that corporations' foreign-derived deduction eligible income, that is the numerator of the fraction in the equation for a taxable year, is its deduction eligible income that is derived in connection with either of the following. And he's talking about, again, property sold to persons outside the United States, services, licensing of intangibles, specific services provided to a taxpayer, any person, or with respect to property not located within the United States. Let's jump to 66.9.3. Professor Loken writes, a corporation's deemed tangible income return is 10% of its qualified business asset investment. That's section 250, little b in parenthetical, 2 in parenthetical, cap B in parenthetical. Its qualified business asset investment for a taxable year is a quarterly average of the aggregate adjusted basis of tangible property used in the production of deduction eligible income that is used in trades of business and is of a type with respect to which a deduction is allowable under section 167. Loken writes at 66.9 after number 4, a corporation's FEDII is its deemed intangible income multiplied by a fraction whose numerator is the foreign-derived deduction eligible income. You see that in front of you, and the denominator of which is deduction eligible income. And that's provided for in section 250 little b in parenthetical, 1 in parenthetical. Let's do Loken's example of the FEDII calculations. This is in the 4th paragraph from the end of 66.9. So let's read that together. Let me read that to you. But again, please read this on your own. Assume US Co., a domestic corporation, has taxable income for 2018 of $1,000 and has no subpart F income, dividends from CFCs, foreign branch income, or other income excluded from deduction eligible income. All of the taxable income is deduction eligible income. Assume $200 of this income is from US Co. sales of goods to foreign persons for use outside the United States. This amount is foreign derived deduction eligible income, the numerator of the fraction at the end of the equation. Assume US Co. has depreciable tangible property used in its trade of business with an average adjusted basis during the year of $3,000. 10% of this amount, 300, is the deemed tangible return, and the corporation's deemed intangible income is $700. Deduction eligible income of 1,000, less deemed tangible income of 300. US Coast FEDII is 140, which is its deemed taxable income return of 300. I'm sorry, I'm sorry, I lost my train of thought. Is its deemed tangible return, and the corporation's deemed tangible income is 700, which is deduction eligible income of 1,000, less deemed tangible income return of 300. US Co's FEDII is 140. It's deemed intangible income of 700 multiplied by this fraction of foreign derived deduction eligible income, the numerator of 200, and divided by deduction eligible income, denominator of 1,000. The FEDII deduction for the year is 5,250, 37.5% of the 140 that was calculated. President Loken goes on to write that the statute contains several rules for use in determining foreign derived deduction eligible income. If a taxpayer sells property to an unrelated person for further manufacture or other modifications within the United States, the property is not considered sold for foreign use, even if the unrelated person subsequently uses such property for foreign use. Loken is citing section 250. B in parenthetical, 5 in parenthetical, cap B in parenthetical, I in parenthetical. Let's jump to the next to last paragraph in 66.9. If a domestic corporation sells property to a related foreign person, e.g. a foreign corporation, the sale is considered made for foreign use only if, 1, a related party ultimately sells the property to an unrelated foreign person or uses the property in providing services to an unrelated foreign person, and 2, the taxpayer establishes to the IRS's satisfaction that the property is for foreign use. And the site is section 250, little b in parenthetical, 5 in parenthetical, cap C in parenthetical, I in parenthetical. In 66.9, next to last paragraph, second sentence, Loken points out, also a domestic corporation provides a service to a related party that is not located in the United States. The service is considered provided to a foreign person or with respect to a foreign property only if the taxpayer establishes the IRS satisfaction that the service is not substantially similar to services provided by such related party to persons located within the United States. There's a typo in Loken's footnote 19, at least as of today. It should be, the reference should be to section 250, little b in parenthetical, 5 in parenthetical, cap C in parenthetical, 2 little i's in parenthetical. Finally, Loken writes in 66.9, last paragraph, that for these purposes, a related party is a member of the corporate group that includes the taxpayer. The corporate group must have a common parent that owns more than 50% of the stock of at least one other member of the group by vote and by value, and more than 50% by vote and value of the stock of each other member of the group must be owned by one or more group members. And any other than a corporation is considered a member of the corporate group if it is controlled by members of the group or controls a group member. The latter rule can be applied repeatedly. For example, if members of a corporate group control a partnership and the partnership controls a second partnership, both partnerships are considered members of the group. I just want to point something out. Last point I want to make with respect to FEDII is that In July 2020, the IRS issued FEDII final regulations, which is Treasury Decision 9901. It encompasses both FEDII and GILTI deductions. One commentator, I think this is Ernst & Young. I'm going to put up an Ernst & Young write-up of those regulations on your class's website. But this commentator observed that most taxpayers will find that the final Section 250 regulations, as compared to proposed regulations, to be quite favorable. In particular, the final regulations adopt sensible rules for taxpayers to document their foreign-derived deduction-eligible sales and services. With that, I'm going to stop here. I'm going to do one more lecture with respect to Module 7, which will be on the BEAT provision, Section 59, Cap A. So everybody have a great rest of the day, and I'll come back with the third lecture on these changes made by the Tax Cuts and Jobs Act subsequently. Thanks, everybody. Bye. And again, email me with any questions.